The financial system is on the brink of an all-out crisis. I'm Steve Van Metre. Liquidation chaos is erupting fast, slamming banks and hedge funds harder than anyone expected. Will the Fed save us? Or is it too late? Now let's head over to Bloomberg, where we find out if we're on the edge of another global financial crisis as Treasury sell-off sends long-term yields soaring worldwide. And I want to understand why this is such a huge problem for the Trump administration right now, because President Trump has asked the Fed to lower rates. They've said right now they're going to stand pat. And when you're fighting a trade war, well, one thing you need is borrowing costs to go down so consumers can have more cash flow and spend money. So what did he turn to? His Treasury Secretary, Scott Bessent, a former hedge fund manager, who said, no problem, I'm going to bring yields down. Now yields are soaring. This is causing major issues in the equity markets, is causing issues at the banking level, and as you're about to see, could tip us into an all-out global financial crisis. The swift rise by pushing up borrowing costs across the financial system is threatening to deliver another hit to the U.S. economy that's already at a risk of recession as President Donald Trump's tariffs upend the world trading system. And right now, this is an issue for consumers because they need to see borrowing costs go down. They're already struggling as delinquency rates are rising on credit cards and other consumer loans. They need some relief here. But what about the banks? When the banks start to need cash, what do? They cut down on their lending activities. And again, we're in a debt-based economy that's powered by the creation of new debt. So this is definitely a strong sign that liquidity in the financial system is drying up and fast. The move has raised fears of selling by overseas investors or a dash for cash as turmoil races through markets as everyone starts to ask questions. Why is the Treasury market rapidly unwinding here? Is this unusual? It's not supposed to happen. We tend to only see it on the forefront of total crises. The surge in yields, which affected everything from mortgage costs to loan rates, is working against what Treasury Secretary Scott Bessent has singled out as a key goal of Trump's economic policy, helping consumers by pulling down borrowing costs. He downplayed any worries of a systemic crisis by saying it was, quote, uncomfortable, but normal deleveraging that's going on in the bond market, and predicted it wouldn't persist. Well, he better hope it doesn't persist, because if it does, it means interest rates are going to skyrocket. It means there's funding issues at the banking level, and all of a sudden, when liquidity seizes up, asset prices plunge. We know what that means. We've seen this game before. We saw it back during the dot-com bubble. We saw it during the global financial crisis. Asset prices start to crash, and who do we need to run to the rescue? That's right, the Federal Reserve. And so far, they've been completely closed-lipped here. Of course, the question is, will they have an emergency meeting? Will QE come back? Will interest rates come down? That is the ultimate question. Was this a planned move now by the Trump administration to dry up liquidity, or is there something else going on in the system? Let's take a look, but I'd love to hear from you. Weigh in the comments what you think is going on. Other traders pointed to a deeper sense of worry and the possibility of hidden risks. Given the intensity of the sell-off, some pointed to the potential foreign selling of U.S. debt and investors ditching whatever they can to quickly raise cash. Now, this makes some sense that we see during a trade war. What happens? You put barriers up, global trade starts to grind to a halt, and in response, in retaliation, the foreign investors and central banks would say, fine, you want to have a trade war? We'll just dump your debt onto the global market, we'll drive interest rates up, and we'll see who capitulates first. Well, the problem is that's not exactly what's happening here, although many people will say it's China who's dumping, but China's been on a long trend of selling Treasury securities, so that's not the real issue here, because we can see, and I showed you this chart of Treasury securities held by foreign institutions and foreign investors. Now let's go back to January 2022, where we see that China has steadily been decreasing their Treasury holdings, and this has everything to do with global trade, because when global trade is expanding, well, countries accumulate dollars and they recycle those dollars back into the United States by buying Treasury securities. So what we've seen from China is they've slowly been reducing their dependency on the U.S., and that means their need for dollars. But what happens in these situations when trade starts to drop, there still is a demand for dollars, because there's a huge amount of foreign held dollar denominated debt. This is what's called the dollar shortage. So it's normal to see selling here, but in terms of panic selling to drive up yields, it doesn't appear to be the case. Another theory has been that hedge funds are being forced to rapidly unwind positions, like in the case of the basis trade blowup of 2020, which might also be fueling additional market turmoil. And now we're starting to get to the heart of what's really going on in the system, is there's a massive amount of leverage by hedge funds in the Treasury securities market. And as this starts to unwind, well, it's causing liquidity issues in the equity markets and causing mass panic across the banking system. Some pointed to the abrupt collapse of a popular wager that treasuries would perform better than interest rate swaps, and it appears that is the case. As we're going into a negative spiral that isn't going to end well as U.S. exceptionalism keeps being discounted. Here we see the head of the currency strategy at Deutsche Bank says we're entering an uncharted territory in the global financial system, and that if recent disruption in the U.S. Treasury market continues, we see no other option for the Fed to step in with emergency purchases of U.S. Treasuries to stabilize the bond market. So what we're seeing here is something called the basis trade start to unwind, and we're going to go through that here in a moment. But what is causing is banks and hedge funds and other institutions to massively unwind and very quickly their long Treasury holdings, meaning what we're finding out is there are no buyers because there's so many people selling. So what this is suggesting is the Fed, being the lender of last resort, is going to have to run to the rescue to keep interest rates from all out skyrocketing. But something else should be headed up. Well, that's your trading account. We put this trade on yesterday to our Momentum Timer Pro subscribers. We told them to buy on the open of this green candlestick, and while now stocks are still down, bonds are headed down, this is headed up. How did we know? Well, we didn't just look at the momentum indicators. We validated this by the trend. And again, if you're trading momentum indicators, what you find out is you get in late, you get out early, and there's a lot of false signals. We've changed the game. Grab the links in the description below. Use that coupon code for your first 30 days on me. Stay tuned to the end of the show because let's talk about this basis trade that could blow up the bond market. But if you want to trade bonds, we'll tell you when to get back in. The basis trade is a strategy hedge funds use to wager on the minuscule gaps between the price of Treasury securities and futures. They typically borrow to multiply their bets up to 50 or 100 times capital invested. Now, I want the key word here. They typically borrow. So when you create leverage, you go out, you borrow money, and then you leverage that into your trade. So the key part to this is they're borrowing money. Rough estimates put the amount of existing wagers at about 1 trillion, roughly double what it was 5 years ago, the last time we saw a crisis in the banking system. Now, problems can arise when the market turmoil upends the economics of the trade and forces investors to rapidly unwind their position, and here's the key part, to repay their loans. And that's one of the dangerous things about leverage. And we talked about this back on our Sunday show, that there's a lot of leverage in the equity market that could come unwound if prices continue to fall. Now you're seeing it happen in the Treasury market, and this is a major problem because it spills over not just into the equity markets, but it causes problems in the banking system in a big way. It can create a cascading effect that causes yields to surge, and even worse if the Treasury market seized up, much like what occurred back in 2020. And what happened back in 2020? Banks failed. We saw bank runs, and next thing you know, there was a massive liquidity crisis. The Fed stepped in, and later on they said, we don't know what caused it, and we don't even know if we fix it. All we know is it went away, and it's never coming back. You might remember back then we said, no, that's not the case. The problem wasn't fixed because they didn't know what the problem actually was. Now we're seeing all this leverage start to unwind, a potential $1 trillion worth of bets, meaning the Fed's going to have to step in a massive way if this continues to unwind. As Zero Hedge pointed out, that it sure would be ironic if the basis trade blew up this week. The Fed's hedge fund bailout facility would need to be somewhere between 1.8 to 1.9 trillion, give or take a few hundred billion, and this is simply because they take on massive amounts of leverage. And what they're seeing right now is because this trade is going the opposite direction, anytime you take leverage or borrow money to get into a trade and it starts to reverse on you, well, you've got to sell and sell fast, because you've got to keep your loan from going bust. And so that's what we're seeing here. As more of these hedge funds are forced to sell, the market for treasuries goes illiquid, the price plummets, interest rates skyrocket. And this doesn't just impact the banks and, of course, the equity markets, as we're about to talk about, but think about it from the consumer perspective. What does President Trump want? He wants rates to come down so consumers will borrow and spend. Scott Bessent said, no problem, I'm the Treasury Secretary. I can get rates to come down because the Fed won't cut rates. So now all of a sudden it's going to impact consumers who could see their credit card interest rate go up and their minimum payment go higher. They could see their access to the lending market drop because banks now prioritizing needing cash don't want to lend out of fear of another liquidity crisis. So you can see right now the stakes are high. The only question is when or if the Fed runs to the rescue. And right now, swaps are massively outperforming treasuries, which are getting dumped and pushing swap rates far below treasury yields, resulting in a negative swap spread rate or a negative feedback loop. So you talk about a doom loop where selling leads to, of course, swap rates falling even more. Let's see some more selling and swap rates falling. The only question is, when does it stop? Now, again, Treasury Secretary Bessent said, no big deal. This is just a temporary dislocation. But it could be something worse. I want to know what you think. Is he right? Is it temporary? Or are we on the cusp of an all-out financial crisis? Weigh in the comments below. Because the bottom line is that funds and banks are panic selling treasuries to raise cash while adding swaps to maintain exposure to interest rates, leading to the record low spread between swap rates and treasury yields across the curve, forcing even more unwinding. The hedge fund manager attributed the moves in yields to the basis trades, said the scale of the broader hedge fund selling was, quote, destroying liquidity or the ability to easily buy, sell assets across treasuries, high-grade corporate bonds, and mortgage-backed securities. Because what's interesting about this trade, now if you're wondering, why does the Fed allow it if they know about this risk? And they do. The Treasury knows about it. They all know about it. Is why do they do it? Because it puts liquidity into the system. When we put liquidity in the system, it actually helps the stock market as well. And it does affect stocks, as Goldman noted that the E-mini top book had just dropped to a record low 1.39 million, even as stock trading volumes hit all-time highs, resulting in insane roller coaster days. The stocks rapidly rise and fall based on the news and moves of the market and what's causing that. What does this mean by top book liquidity? Well, it means if you're going to come into the market and sell more than 1 million worth of E-minis, that's the S&P 500 futures, what it means is there's not enough buyers to absorb that sale order, and it means price has to fall until it finds buyers. If it doesn't, it falls even more, and it continues to fall. Now, in a healthy, normally functioning market, there's plenty of liquidity, so buyers and sellers are matched and prices don't fluctuate that much, which is why the VIX is at current level. So what you're seeing here is this issue in the treasury market is spilling over into the equity market. That lack of confidence then spills into the banks, who are now starting to hoard cash. They don't want to lend because they're afraid of going under. And next thing you know, for consumers, it means they're iced out of course, being able to borrow at a time when we know consumers are cash strapped and definitely need to do that, which is why we saw refinances surge this last week as consumers take money from their one last place they can, that is their home. Of course, we know how that played out during the last crisis. And this multi-trillion basis trade is blowing up, and countless funds and banks are unwinding position, but there may not be enough liquidity in the system, and this is why many people are now saying the Fed will run to the rescue. It's only a matter of when. It could be, of course, today, could be tomorrow. The question is, will it stop? Because a lack of liquidity shockwave is rampaging all across markets, sending stocks plunging. It's affecting currency markets, bond markets, because this means there's an acute shortage of dollars, as a global synthetic dollar short sitting around 6 trillion is even bigger than the basis trade. So what you can see is as financial crises start to brew, it spills over into other markets, spills over into other trades, and next thing you know, you find out that the global markets are highly leveraged and subject to a complete annihilation. And yet we have critical liquidity events such as today's 10-year auction, tomorrow's 30-year auction. The question is, if the auctions fail and come out with very poor results, how long will it be before the Fed runs to the rescue? We don't know, because Powell recently said that, look, we can't respond to what's going on because there's too much uncertainty. But if the Treasury market goes, they will come to the rescue. This is something that Democrats will be very unhappy about. Of course, we know Trump wants the Fed to step in here, but this is the issue we're now facing. Is any of this having to do with China? Well, they responded last night as China raises tariffs on U.S. goods to 84% as trade rift worsens. What's interesting is many of you in the comments said China's going to be the winner here, that there's no way we can. Again, this all comes down to the biggest question of all: whose economy is stronger, the U.S. or China's? China's economy is in far worse shape. Now, many of you said not a problem, they're going to stimulate, but no worries. We've seen them do that and it doesn't work. My bet is they're not going to come out the strongest, but many of you said they would. We'll find out soon enough. As U.S. Treasury Secretary Scott Bessent branded Beijing's retaliation as, quote, unfortunate in an interview recently and urged China not to devalue the yuan. Again, we've made the case that that is likely what China will do. But what you can see here as this trade war evolves, that the ultimate goal was to get China to the trading table and make a deal just like what happened under Trump's first term. Problem is this time they don't want to make a deal, they want to fight. And so now we're seeing a huge pivot as such a move of devaluing the yuan would be a tax on the world. So notice the pivot here now is the tax would be on the entire global economy. The Chinese actually don't want to come and negotiate because they're the worst offenders in the international trading system. We can probably reach a deal with our allies, and by the end of the day, Besant said they've been good military allies, but not perfect economic allies. And once we make a deal, then we can approach China as a group. So you're seeing the pivot here that China didn't respond as the administration hoped. Now looking to make deals with other countries and then take China on as a whole. Again, the question is, whose economy is the strongest? Keep in mind, China is more dependent on us at the moment than we are. We've got a lot of inventory, and the inventory on the ships on their way isn't subject to the tariff, giving us a little more latitude of runway than the Chinese economy has. But just because of what's going on, it doesn't mean there's chaos in other markets now, as Texas wildcatters are growing impatient with Trump as oil prices tank. Prices are now hovering around 60 a barrel, below the level they say they need for new wells to break even, according to the Federal Reserve Bank of Dallas. So think about this. If we see prices go down of crude oil and oil companies can't break even by opening new wells, what does it mean they're going to stop doing? Well, it means they're going to stop drilling. And what you're going to find out is that means the current new order book for Texas is likely to plunge. And when you compare this to West Texas intermediate crude prices shown in red, you start to see a wonderful relationship show up after the global financial crisis. And that is, as crude oil prices rise, shown in red, what happens is the order book for Texas remains in positive territory, but as oil prices fall, look what happens to new orders as they go down. So there is a strong relationship between the Texas economy and crude oil prices, suggesting there's a big problem, because if crude oil prices continue to go down or stay low, well, it means oil companies are not going to drill. And if you don't drill, well, you don't need labor. And so now let's take a look at that current new order book for Texas, still shown in blue, now against continued unemployment claims in red. And you can see going back into the global financial crisis, new orders were coming down and continued claims were rising. You can see the risk now that if oil prices fall, it likely means the new order book in Texas is going to decline. And that means workers are likely to hit the unemployment line. And this is the risk for the U.S. economy. Many of you said that, wait a minute, Steve, we don't think you understand the risk here for the U.S. The answer is I do understand them. I just think China's economy is more likely to break first. We'll find out how this all plays out in time. So as I start out the show, we're on the cusp of what could be a global financial crisis. This one could be centered here in the United States on our banking system. The Fed better be right that this is temporary. Either that or the Fed better run to the rescue and fast. But just because the equity markets and bond markets might be melting down doesn't mean there's opportunities in this market. We see momentum trades are blowing up all across the board, because when people trade just the oversold indicators, what they find out is you can go from oversold to even more oversold in a flash. But we look at not just the technical indicators on our Momentum Timer Pro report, but we also look at the trend. And then what we saw yesterday is this opportunity flashed on a report, and we told our subscribers to buy at the open on this green candlestick. And what you can see is the following day, today, it has shot up and looking to break out even higher. Now, how do we do this each and every day? We run a screen on momentum across the 1 day, 1 month, 3 month, and 6 month windows, but we also added a historical overlay to add the trend into the signal. So not only do we see when momentum is up, we validate it with the trend. It increases the probabilities that the trades will be successful compared to just trading the technical indicators themselves. But not only do you get the daily report, because not only do you get the daily report and the tradable signals, but we integrated all of that historical data to give you, of course, the hot list of trades that we think are the best. But on top of that, I review each and every trade to give you my opinion on. You get full tracking of all trades and returns, a weekly update, and here's the best part, your first 30 days are on me. And why do we do that? Because we're so confident you can make money trading on report. We want you to come in without any money out of pocket. Use the links in the description below. Grab those coupon codes for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.